It's almost 1 p.m. in Sydney, 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks extend a Wall Street rebound as investors look beyond politics to focus on tech earnings season. Tesla and Alphabet, the big names, reporting later. Kamala Harris reportedly has the required delegates to secure the Democratic presidential nomination after shoring up support from key party leaders. Also ahead, India's first budget under the new coalition government, set to curb the deficit while still cutting taxes. Plus, we get a budget wish list from the CEO of India's biggest steelmaker, JSW, after net income plunges 64% on sluggish exports. All right, first up, let's get a check on how markets are faring. Avril Hong's in Singapore. Avril.
Yeah, Paul, we're finally seeing Asian equities catching a bit of a break after a three-session losing streak. They're tracking that rebound on Wall Street. Perhaps a useful reminder that in terms of equities, perhaps what matters more is the Fed's path and earnings. Don't forget some of those Mag 7s report this week, more so than perhaps the uncertainty surrounding U.S. policy. Against that backdrop, also worth highlighting that these high-flying tech names did slam into a wall last week. We saw that sector rotation, the concerns about these lofty valuations, as well as uncertainty surrounding the U.S. kind of spur that sell-off in the tech names. Today, we're seeing the tech-rich benchmarks leading the way. China's still pretty negative. Now, I wanted to highlight what we're seeing in Japan as well, because Bloomberg has learned that the weak consumer spending we're seeing in Japan might be reason enough for some of the policymakers to skip that rate hike next week. The BOJ, of course, meets for a policy next week, and we're seeing that showing up in Japanese bonds. But the yen is still climbing, as it has been in the past 2 weeks. More recently, though, one of the dynamics that we're seeing emerging is the U.S. political uncertainty, perhaps an environment that favors yen buying. Paul.
All right, thanks, Avril. Well, Vice President Kamala Harris has now reportedly got more than enough pledged delegates to clinch the Democratic presidential nomination. An unofficial AP tally shows she's crossed the magic number of 1,976 delegates. Harris spoke earlier today from her campaign headquarters in Delaware as she gets ready to take on Donald Trump.
We are all here because we love our country, right? And we believe in our foundational principles. We believe in freedom and opportunity and justice, not for some, but for all. We are going to win. So in the days and weeks ahead, I, together with you, will do everything in my power to unite our Democratic Party, to unite our nation, and to win this election.
All right, for more, let's get to Bloomberg's Vonnie Quinn joining us now from Washington. So, Vonnie, the nomination appears to be in the bag. Is there still any possible challenge to Harris?
Well, anything can happen, as you know, Paul, in any election, but in particular in U.S. elections, it would seem. That said, with more than 1,976 delegates now, she has a majority. They don't have to continue to pledge their support, but it's very likely that they will. It won't become absolutely official until the DNC or shortly before that, but it looks like this is what the Democratic Party wants. We also saw people like Nancy Pelosi and other elders, for example, give their support today. Very few people left to actually offer their endorsement. We've got more governors and so on offering their endorsement. And the campaign is really in full whack now. You saw there in the pictures, the Biden campaign headquarters is now the Kamala campaign headquarters. So they turned the Biden campaign headquarters into Kamala's headquarters and rebranded it as Kamala. So just one name, her first name. She wants to get out there. She wants the electorate to know who she is. Yes, they know she's been the vice president, but it's a whole different matter now that she is going to be at the top of the ticket and running against Donald Trump. And you heard her speak to her campaign staff there. Joe Biden had actually called in. So before she gave that speech about Trump and what she was going to do for the campaign season, we did hear from Joe Biden pledging his support to her and saying he is going to be on the campaign trail with her, even as he continues to serve out his presidency.
So the campaign, as you say, underway. What's she focusing on when it comes to campaigning against Trump and persuading voters?
So a little bit of attack and a little bit of policy. You heard there some of her kinder words, but she also said that in her role as Attorney General and previously prosecutor in California, that she had seen all manner of predators, fraudsters and cheaters. And I'm quoting now, she said, "So hear me when I say I know Donald Trump's type." So she won't be afraid to go on the attack when it comes to Donald Trump, who's already been calling her dumb as a rock, Kamala Harris. But she also will get into policy. She mentioned some of the areas that she'll be concentrating on, including women's reproductive rights, which she's been extraordinarily strong in. She's also been strong on climate change and on various other matters. So she will be getting into that. And she begins tomorrow in a swing state, Milwaukee, Wisconsin. You most recently heard of that because it was the site of the RNC, which did seem to unite Republicans just last week, it appears.
Well, yesterday, of course, we have world leaders paying tribute to President Biden after he stepped down from the nomination. How are world leaders reacting to Kamala Harris?
A mixture, Paul. Very few are withholding any kind of commentary. China is one that's saying nothing officially. But in Europe, for example, there's a lot of goodwill. There's a lot of curiosity as well. One Eastern European official told Bloomberg that really it's just the quote-unquote bad guys in Europe that are not for her, saying that that would include Hungarian Prime Minister Viktor Orban, Serbian leader Vučić, and also, of course, Vladimir Putin. They've all clashed with the European Union in one way or another. But they're all curious. Even Vučić put forward an opinion saying that she should choose Michelle Obama as her running mate. And apparently Vladimir Putin's spokesperson said her contribution to bilateral ties, quote, hasn't been noticed. So they are taking notice of the fact that this is now the person who's going to be running opposite Donald Trump. As for the current situation, we do know that the current President Biden's top diplomatic and defense officials are proceeding with a trip to Japan and the Philippines this week. It's all full steam ahead when it comes to foreign policy right now. For the next 6 months, Kamala Harris herself has been an active presence in the Asia-Pacific region over the years. You'll remember last year she had lunch with the South Korean president, and an official in Tokyo said officials there are optimistic because she's already formed a strong rapport with her Japanese counterparts.
All right, Bloomberg's Vonnie Quinn there in Washington. Thank you. Well, let's bring in our first guest who says his focus is on ideas with the best risk returns regardless of election outcomes. Joining us from Singapore now is George Efstathopoulos, Portfolio Manager at Fidelity International. So, George, it's been an interesting 24 hours. We've seen the unwinding and perhaps the rewinding of some of those so-called Trump trades. I mean, one of them is the curve steepener. We have a chart of that now. That's a popular Trump trade. What are you doing with US Treasuries right now? Are you part of this curve steepener crowd?
When it comes to treasuries, we try to focus on growth and inflation and what the central bank sort of could be doing. And we have seen essentially sort of better inflation prints in the past 3 months or so. So that's been quite encouraging when it comes to the direction for treasuries. But at the same time, we do think that growth remains resilient. Yes, there have been some weaker prints across different data points more recently, but generally speaking, we think this is just a moderation from the very high levels of growth that we had so far. So all in all, when it comes to treasuries, we are a bit light on duration. We're not as constructive on treasuries, and especially looking sort of further out into 2025, because again, growth is strong. And if we look at financial conditions, they're actually very easy. The easiest they've been in the past 2 years. Could we potentially see a reacceleration of growth come next year? Potentially. So as a result, we are staying a bit cautious on the Treasury front.
And how about in terms of the US dollar? How do you trade that heading into the election? Because candidate Trump has said he'd like to see a weaker dollar, but at the same time, protectionist trade wars and tariffs are possibly not the way to achieve that.
I guess regardless of who wins the elections in November or the run-up to the elections in November, if we end up seeing more protectionist measures, and that does have a bit of a bipartisan support, typically protectionist measures do lead towards sort of higher inflation. You know, that's one thing, and the implications this can have on currencies. But if we pivot back to sort of fundamentals, because currencies are also driven by interest rate differentials, they're driven by inflation differentials. I think what we've been seeing more recently when it comes to yen strength, for instance, I think that's quite interesting because we're starting to see yen, perhaps the dollar yen, start moving a little bit closer towards fundamentals, because it had started to deviate away from interest rate differentials, and now we're starting to see a little bit more of that convergence. So I think focusing on interest rate differentials, growth differentials, that's what's very important.
Yeah, that might be a good opportunity to talk about some of these central bank decisions that are coming up. Let's talk about the BOJ first. So the expectation is we're going to see some tightening, but there is a bit of nervousness around weak consumer spending in Japan as well. But if they hold off, do you feel like they might miss their opportunity next week?
I think having a gauge for timing is difficult, but generally speaking, directional travel we think should be tighter from these levels. And there's two key aspects to this. First of all, look at inflation expectations, consumer inflation expectations. They're now close to record highs, and that has obviously implications in how the Bank of Japan will be thinking about this, and also what this means for wage expectations next time around, sort of for Shunto wages. The other bit, which I think is very, very important, is services PPI, right? We had last month's print was a record strong print, one of the strongest prints in, if I'm not mistaken, almost 30 years. And the other important aspect on that front is that it was broad-based. It wasn't just about tourism-related services PPI. Bank of Japan wants to see broader inflation, and that's exactly what we have been seeing when it comes to services PPI. And also, let's not forget that services PPI turned negative 30 plus years ago. That was a leading indicator towards the deflationary period that Japan has had. Now that's going the other direction. So when it comes to the Bank of Japan, we think directionally expect more hikes. When exactly, that's the more tricky part.
Yeah, all about the timing, and really the same situation for the Fed. I mean, I guess you could say July is a live meeting next week, but do you think the Fed really wants to move before the election and risk getting dragged into a political debate?
I think the Fed will focus on data. It's data-driven. They've told us that, and that's what they continue to do. And the more recent inflation prints have been supportive of a potential sort of easing of interest rates. So that's one thing that they will have in mind. But at the same time, some of the inputs towards the inflation prints have been some of the more volatile aspects. That's one thing. The other aspect, it's very encouraging to see rents and rent-related inputs towards the CPI easing off. So that's a good thing. But we've seen a lot of immigration the past several months into the US. And that immigration at some point, there was going to be a lot more demand for housing, for whether it's kind of purchase or on the rental front. We haven't seen that data come through. That's potentially something that might be affecting the mindset for next year. So yes, on the one hand, the inflation prints that we have seen and growth trajectory potentially allows for the Fed to ease somewhat. But we're a little bit more skeptical about what the Fed can deliver for next year.
George, we've talked a lot about the macro backdrop. What are your top calls at the moment?
One of the views that we have is US mid-caps. And I know there's been a lot of noise around politics and to what extent we've got the politics driving the rally, the rotation between large caps and small and mid-caps. But actually, we don't necessarily think it's the politics. Instead, it's more the expectations of interest rate cuts that is driving this rotation and sort of the multiples re-rating in that space. Now, we're a lot more cautious on the small caps because we think at this point in the cycle, we don't want to focus on the lower quality end of the spectrum. The mid caps, on the other hand, we think there's, the profitability looks better, fundamentals look a lot better. And again, they're more domestically focused and the economy has been strong and continues to be quite resilient. As such, we think that's an area that's quite attractive, regardless of which party wins the elections in November. Now, if there were to also be some tax cuts, that's clearly a positive.
All right, George Efstatopoulos of Fidelity International, thanks so much for joining us today with your insights. Still to come on Bloomberg Markets Asia, we preview India's budget. Goldman Sachs chief economist and is going to be joining us, talking about whether the Modi-led coalition can manage to cut both the deficit and taxes. Also, we're going to hear from the joint CEO of JSW Steel about the company's plans for growth after a first quarter earnings miss. This is Bloomberg. China has avoided officially commenting on Kamala Harris's late entry into the US presidential race, saying it's America's internal affair. But Chinese social media users are keeping a close watch. China correspondent Min Min Lo joins us now from Hong Kong. So, Min Min, tell us, what are people saying online in China?
Yeah, there are lots of social media chatter in China. People are watching this election very closely, and on Chinese social media website Weibo, that hashtag Biden exits has now garnered over 500 million views, and it seems like many people are betting on a Trump win, with one poll on Weibo of 12,000 people showing that 8 in 10 believes that Trump is going to win that election. Not as many vote of confidence for Kamala Harris, perhaps because of her lack of exposure in China. Some analysts have pointed out that Kamala Harris has not had a track record in China. She doesn't have the sort of long-standing relationships with global leaders like President Xi. She also hasn't been to Beijing in her official capacity as vice president, although she has met with President Xi on the sidelines of the APEC summit in Bangkok. So analysts are saying that she will really need to start building up her trust with national security advisors to guide her on her China policy. But with Trump, though, he's been president before, and especially after that attempted assassination attempt, that photo of him pumping his fist in the air has gone viral in China, with many people commenting about how courageous he was in the face of vulnerability.
Yeah, and in Beijing, we do have President Xi said to be cementing his role as the chief economist and shrinking the space for debate. What are the implications of this?
Yes, this is a report done by our colleagues in the Bloomberg newsroom based on conversations with many economists and experts in and out of China. And what we found is that over the first decade when President Xi was in power, there had been many of these discussions between Chinese policymakers and foreign analysts and economists. And these are informal discussions that provided a way for alternative points of view to be floated up to the Chinese leadership. But increasingly in recent times, we are seeing these meetings becoming less regular and becoming more formal, lacking the sort of in-depth and meaningful discussions we've seen in the past. And some Chinese economists are telling us that they're not sure if their proposals are being heeded by the government, with officials often seen nodding and taking notes rather than participating in informal discussions. And so the risk here is, if Chinese analysts are beginning to feel less comfortable with voicing their concerns about the economy, then perhaps the Chinese leadership would increasingly be in an echo chamber and making policies that may not necessarily reflect what's going on on the ground. And we've seen how President Xi, as well, in his unprecedented third term in power, surround himself with a team of loyalists, displacing the older generation of trained economists, the likes of former Premier Li Keqiang and the Vice Premier Liu He. And the current Premier Li Qiang, he has cancelled and ended that 30-year tradition of holding an annual press conference every year in March. So that also reduces the face time that foreign journalists get to have with Chinese policymakers as well. So increasingly, for the investors' point of view, just from the outside looking in, there's just less and less information we can glean about the Chinese economy.
Yeah, well, if we take a look at the domestic economy, we've got overall government spending falling in the first half of this year. It's worsening the slowdown. What's going on?
Yeah, so overall government spending has fallen by nearly 3% in the first half of the year. And that's all about the local government pulling back spending. Their reluctance to spend. Local government spending has fallen 4.2%. Look at that chart there. The lowest line, the red line, is the local government spending falling 4.2% compared to the same period last year. Even though that blue line, central government spending, has gone up by 10%, but it's not enough to lift that overall spending. The white line over there is still down nearly 3%. And this comes as government revenue as well has fallen sharply more than spending, and increasing that budget deficit to 3.6 trillion yuan, and that government revenue falling largely because of a drop in government land sales, which has fallen by 18%. Property deed taxes has fallen by 10%, and that's why you're seeing that that third plenum, the government rolling out this major tax and fiscal reform to reallocate more resources to local governments in a bid to get them to spend more in the local economy to boost stimulus and lift growth in the second half of the year.
All right, Bloomberg's China correspondent Min Lo there. Still to come, we'll have more from Min with her exclusive interview with the CEO of Chinese EV maker Zeekr. Hear about their plans to avoid EU tariffs and further their international expansion. That conversation up next. This is Bloomberg. Zeekr, the premium EV maker under Chinese auto conglomerate Geely, says it's considering using European production to avoid EU tariffs. CEO Andy Ahn told us exclusively about the brand's global growth ambitions, including the launch of a new offering in Hong Kong.
Zeekr is a global brand and a luxury high-end brand. As to why we had our launch in Hong Kong, everyone knows Hong Kong is a leader in the use of multi-purpose vehicles and the birthplace of luxury MPVs. This release is very meaningful as this is a global launch, targeting global markets for simultaneous sale. This is a very important turning point for our global strategy and planning.
Let's talk about international markets because we are seeing a wall of tariffs from the US, EU, possibly Canada, and Turkey as well has just announced 40% tariffs on Chinese EVs. So how big of a blow are these tariffs on your overseas expansion plans?
Of course, regarding the introduction of these policies, I personally express my regret. I think these decisions are not right. For us, we very much follow international free trade. I should say for Zeekr's international development, there will be a certain impact. As for how to face this impact, I think we can plan for the short, medium to long term as a whole. First, I think we need to work hard to improve our brand image, boost our technological competitiveness, our high-quality products, and a good service experience for users. Second, we should consider localized production in each area. For example, in Europe, Geely has been making cars for 30 years and has been proactive in building the foundation for internationalization. So in the future, we won't rule out using the resources of our holding group's partners to compete in the market.
That's Zeekr CEO Andy Ahn speaking exclusively with our China correspondent Min Lo. All right, let's take a look at how some of the key stocks in China are travelling at the moment. Here's a look at chip stocks. We've got the Hang Seng Tech Index sliding a bit. The index as a whole is off by about 1%. We've got TSMC, though, performing pretty strongly today. Hon Hai also better by more than 4% as well. Take a look at BYD, meanwhile. We've seen their Hong Kong-listed shares slipping. Berkshire Hathaway sold off another block. It's now got a holding under 5%. That means it doesn't have to disclose any further stake sales or whether it exits that position altogether. BYD shares off 3.25%. Still to come, preview of India's budget. Goldman Sachs chief India economist is going to join us. Hear which sectors they think might be winners and losers. Up next, this is Bloomberg. All right, welcome back. We've got markets in China just heading out to lunch. Here's a look at how we're doing. A little bit off the pace in Hong Kong. The CSI 300, meanwhile, that's off by about 1% at the moment. Other markets around the region are performing pretty well, but we're seeing a little bit of softness in China. Still some concerns circulating about, the limited support which seemed to be coming out of the plenum, which concluded last week. Those rate cuts that we saw yesterday, not doing a lot to support sentiment. All right, let's check in on how markets are faring elsewhere. Avril Hong's in Singapore. Avril.
Yeah, Paul, we're focusing as well on another major Asian economy, India, as we have the finance minister later today going to deliver her first budget speech under the new coalition government. The rupee as well as India bonds are in focus ahead of that. Yesterday, we saw the Indian currency hit fresh record lows against the greenback. This had more to do with the broad dollar moves, but the rupee is also in focus if we see further fiscal consolidation from this budget. That could provide a further tailwind. Indeed, the likes of DBS Bank's Radhika Rao says we could see on the 10-year the yield prod below the 6.95% level. I'll flip the board because, as I say, it's about the extent in which the Indian government can come through with this fiscal consolidation, something it's been managing to do quite successfully, bringing that down steadily since the pandemic peak of about 9.2%. But it is also a relatively tricky balancing act. The government will have to balance what it's getting from requests from billions in spending from the key coalition partners. It might get a bit of a help from the RBI in terms of bumper dividends. But again, as I say, a bit of a tricky balancing act going forward here, Paul.
All right, thanks, Avril. Let's get some more on the budget now. Bloomberg's Menaka Doshi in Mumbai joins us. So, Menaka, we had a little bit of a sneak preview from Prime Minister Modi yesterday. What are you watching out for?
Exactly as you pointed out, this is the first budget of the third term for Prime Minister Modi and his BJP party. So do expect an articulation of what their plan will be for the next 5 years. And that articulation will likely cover everything from infrastructure building to expanding the manufacturing production incentive schemes to AI and the impact on jobs to adding more jobs to the economy, and maybe even a portion, if the economic survey from yesterday gave us a hint, of the relationship with China and whether that can be expanded from both a trade, but more importantly, an investment perspective. Now, those are all long-term 5-year things. In the more immediate focus will be how the finance minister, as your previous speaker pointed out, balances this budget. She has some extra money this time, roughly between 18 to $20 billion on account of that RBI dividend and on account of better than expected personal income tax collections. And that extra money, everyone will watch to see whether she puts it towards reducing the fiscal deficit lower than what was anticipated in the beginning of this year. The target is 5.1%, but she may go all the way down to 4.9%, according to some economists, and that will be, keeping with the fiscal discipline that this government has maintained over the last 10 years. Or she may choose to spend it, because let's remember, this is the government that came back on a very weak, fractured mandate. It was not able to win majority on its own. It needs to rely on two key regional allies. So it may choose to spend to ameliorate those parts of the economy that seem displeased with the government, and it may also have to spend to keep those allies happy.
All right, Menaka, stick around. We're going to get some more analysis with our next guest, who believes India's budget will go beyond just fiscal numbers. Shantanu Sengupta is Chief India Economist at Goldman Sachs, joining us now, also from Mumbai. Shantanu, thanks so much for being with us today. So it looks like maybe lower taxes, higher spending, and the dividend from the RBI that Menaka was talking about there. Is that going to be enough to prevent a blowout in the deficit or that from getting any bigger? And where do you see that money going?
Yeah, so we see the government sticking to the fiscal consolidation path. They have done a great job in terms of bringing down the deficit from over 9% of GDP to near about 5.5% of GDP. We think they're going to stick to 5.1. If anything, they could go a tad lower. But the more important thing is the medium-term fiscal consolidation path, which gets us to 4.5% of GDP or lower by fiscal year 26. The background to all this is that India's public debt to GDP is 80% plus. And, we are spending about 3.5% of GDP on the fiscal account for the central government on interest expenses. And therefore, an expansion of the deficit at a time when growth is looking pretty solid at about 8% will probably not be the policy path that the government will take. But what we have been advising investors is to look beyond numbers. We think that the government will use this budget to make a more broad brush statement about the long-term policy and economic goals rather than just minor stimulus announcements. This is going to likely aligned with the government's development agenda for 2047, coinciding with the 100 years of Indian independence. So that's going to be the big picture announcement, we think, in the budget, rather than just tinkering around with fiscal deficit numbers.
How strongly is the political dimension going to feature here? Because, of course, Prime Minister Modi relies on a couple of smaller coalition partners to remain in power. What sort of spending do you anticipate to keep them happy?
Our assessment is that the political dimension is going to be only partially met through the fiscal balance sheet. As you've seen with the Andhra Pradesh government, there's a new refinery announcement that has come up. So it's going to be more of infrastructure set up, or factories being set up in those states, particularly Andhra Pradesh, rather than just a fiscal transfer, which is going to take care of this. Because frankly, given where the overall public debt situation is, and given the infrastructure requirements of the economy, India doesn't quite have the fiscal space to keep spending their way through, just to keep the coalition happy. So we think the arrangement is going to be more outside the fiscal balance sheet. Of course, there is the extra 30 basis points of GDP dividend that the government has got from the RBI. Part of this could be spent for instance, welfare spending or transfers, subsidies. But to sustain that over multiple years going forward is going to be difficult, especially given that you're on a fiscal consolidation path.
Shantanu, given the external scenario is so unpredictable and volatile at this point, especially the US elections and what that might throw up, don't you think that the government or the finance minister, would be better placed to strengthen the domestic economy and demand in the domestic economy and take whatever little space she has to be able to do that? Though I know it's a tricky response, given that it's not easy or direct to do that.
Yeah, Manika, I agree that they will take all steps to strengthen the domestic economy. I don't know how much of that will be just stimulating aggregate demand through fiscal transfers, because again, as I've said, the space is limited. So those focus, we think, will be on the rural economy, but a thrust on rural infrastructure through food supply chain management, inventory management, just to contain the domestic price volatility, which ultimately eats into real income. So better connectivity in the rural areas, incentivizing domestic food production, storage, food processing. The other segment could be job creation through more labor-intensive manufacturing, where you can see some fiscal incentives moving in towards the more labor-intensive parts. Could be textile, could be footwear, toys, all of these sectors, whichever is more labor-intensive, which can integrate India into the GVCs, and then support for the MSMEs and therefore further for the skilling of that segment so that they can come into productive capacity. That is going to be the focus more, in our view, rather than just fiscal transfers or dole-outs.
And a quick follow-up question on, what markets will also be watching for, Shantanu, which do you anticipate any changes on the tax regime, not just income tax, but also capital gains tax that could impact both investments in equity and in debt? That's one part of that. And second, the economic survey, was one more red flag towards what some might describe as an asset bubble or excessive speculation in the markets, especially on the F&O end by retail traders. Again, are you expecting anything from this budget to address that?
So on the regulatory front, it's the RBI and SEBI which has been working in tandem on the financial markets. On the taxation front, there has been this long-standing issue about equating capital gains taxes. We'll see which way that goes. But we think that the market focus is also going to be on the issuances, where we've talked about the long end of the yield curve being really anchored, given the savings flow that you're seeing into pension assets, into insurance companies, and all of the long duration investors, which is helping to keep the 10s, 20s part of the curve completely flat, which is great for the government because they are able to borrow at much cheaper rates and long term. So they're able to have their issuances also go longer, which we think is going to be good for the markets, because if you roll this story 2 years forward, then you're having this demand from long-term investors, whereas the supply of securities from the government as a percentage of GDP is going to come down as the government consolidates the fiscal deficit, in our view, at 4.5% or lower in FY26.
In terms of GDP percentage, do you see any policies to support manufacturing and increase manufacturing share of GDP?
We think the focus is going to be on aligning fiscal incentives towards job creation in the labor-intensive manufacturing segment. Already the PLIs are being rolled out for multiple sectors, but the thrust this time probably on the labor-intensive sectors is what we would expect. As I said earlier, it could be textiles, could be footwear, toys, leather products, and so forth.
Let's talk about the performance-linked incentive scheme as well. Do you anticipate more industries being brought under that scheme?
Rather than more industries, we think the focus is going to shift towards labor-intensive part of the manufacturing chain rather than the more capital-intensive ones. Because one of the points that the economic survey has also made is that of job creation. And if you really want job creation, and if you want fiscal policy to help that, then the incentives probably is going to be more aligned towards the labor-intensive part of the manufacturing segment.
All right, Shantanu Sengupta of Goldman Sachs. Menaka is going to stay with us for more India-focused coverage coming up. We'll be talking to the joint CEO of Indian steelmaker JSW Steel. We're going to discuss their budget wish list as well as their growth strategy after reporting a first quarter earnings miss. That's coming up next. This is Bloomberg. All right, welcome back to Bloomberg Markets Asia. You're watching the India Focus. Here's a look at India markets just ahead of the open. We've got just over 1 minute to go. Pre-market looking pretty healthy there. The Sensex better by about 0.25%. Similar story for all those major indexes, in fact. We will be keeping an eye on JSW Steel. We are hoping to speak to the joint CEO shortly, but he does have other commitments as well. It is also, of course, budget day. So things perhaps tracking a little bit sideways as we await the finance minister's announcement. And on that note, let's get a little bit more on the budget. Bloomberg's Menaka Doshi is with us in Mumbai. So Menaka, bit of a different budget this time around because, of course, the Modi government has to consider the needs of a couple of coalition partners. How's the market positioning ahead of this?
You're right, Paul. As Bloomberg has reported, those two key regional allies have made demands adding up to almost $15 billion. The expectation is that not all of it will be met. And as we were just speaking with Shantanu Sengupta of Goldman Sachs, some of it might be met off budget through, large public sector investments in those key states. The markets will be watching a couple of critical things from a short-term basis. And that, of course, will be the fiscal deficit number and whether that is going to go lower than the anticipated 5.1%, which is what was set out earlier this year and is part of the glide path that India has committed to as part of fiscal responsibility. If that goes down a wee bit to 5% or 4.9%, as Shantanu pointed out, that might be looked at as a material significance to the debt market. Remember, India also just recently joined the JP Morgan Emerging Market International Bond Index. And so therefore, it's important to keep a wider set of bond investors happy. So we'll see that from a fiscal discipline point of view. The markets are also watching to see if there's likely to be any impactful change when it comes to income tax and capital gains tax. income tax such that it improves or increases the spending power across middle class India. That has been that is a long-standing demand ahead of every budget. But more importantly, capital gains tax. This is something the government has flagged in previous years, that there is an unequal imposition of capital gains across different asset classes. They have preferred in the past not to tackle with it, but the market will be watching to see if there are any signs or indications of any changes there.
All right, Menika, please do stay with us. We are joined now by one of India's leading steel makers, India's steel companies, of course, hoping the government is going to continue its massive capital expenditure with a focus on infrastructure development. Let's talk about this some more with Jayant Acharya, Joint MD and CEO at JSW Steel, India's largest steelmaker, as I mentioned. Bloomberg's Menika Doshi is still with us in Mumbai. Jayant, thank you so much for your time today. It is, of course, budget day, as we're discussing. We're expecting some tax cuts, fresh spending as well. Do you have any inclination where that money is going to be spent on, where it should be spent on?
I think this budget will be, again, pro-growth and pro-job creation. We would continue to see a focus on capex spending, both in infrastructure, digital, physical, social. There would be some initiatives we expect on the consumption part as well, which could be part of the tax story which we're just talking about. Overall, I think this budget would be very positive for the steel industry, because the infrastructure, manufacturing, as well as the energy transition, which India is going into to go to renewable, are very strong steel-consuming sectors. On the growth of the general demand in India and a very positive sentiment, we see the consumption space picking up, right from automotive to appliances to packaging. So I think those sectors will continue to be supported by an overall spend by the public capex, as well as the improving private capex right now. So story looks good.
Yes, and of course, JSW Steel, an obvious beneficiary from the infrastructure push. Can you tell us how important that has been to your bottom line in recent quarters, and where you expect that trend line to head now?
So infrastructure spending has an overall economic multiplier across the country at large, across various sectors. It creates employment. It creates a lot of economic enablers for growth. It's been a very positive kind of a tailwind for the steel industry. The second one has been the manufacturing push and the energy transition. As I said, on the energy transition, we are reaching close to 200 gigawatts of various renewable portfolio. Our intention as a country is to be 50% on renewable by the end of this decade. And I think that growth is now being enabled both by the public sector, the government, as well as the private sector. And that consumes, again, a lot of steel. We see the consumption on automotive playing out very well. People are very much more positive. Housing is gaining traction. And that, again, will continue to grow across the country, both from an affordable housing point of view and normal housing across the urban cities of the country.
Jayant, in the previous quarter that you just reported for, imports, especially cheaper imports from China, continue to be a problem for the steel industry. What's your outlook on that going forward? And also, if you could quickly talk us through where you see raw material costs going, specifically coking coal?
Yeah. So imports into the country going up is a concern, Menika. As you rightly said, I think we are concerned because India became a net importer last year. In the quarter gone by, India's imports went up by about 27%. China and the FTA countries by a higher percentage point. As India is growing at a very fast pace economically compared to the rest of the world, we are more vulnerable. And therefore, I think there is a need for us to look at appropriate trade measures. Most of the other countries are reacting to that and putting that in place. I think it's time for India to look at that and put some measures in place so that we encourage fair trade, but we do not encourage unfair trade at predatory prices. As far as the cost position goes, the coking coal prices have been going down. Last quarter, we had a $23 gain quarter on quarter. This quarter, in quarter two, we expect a similar drop going between $23 to $28 coming into the quarter two as well. Iron ore prices are softening, so that should improve the cost position.
And Jayant, a quick final word on capital investment. You all have upped that in the quarter gone by. It's telling on your debt numbers as well. What's the forecast for the rest of the year?
Yeah, so we spent close to 4,500 crores for the capex last quarter, and we will continue to drive our capex as per our guidance. The debt went up primarily because we repaid $300 million of acceptances, and we built in some working capital for the new invent facilities which are coming on stream. As the volumes from the new capacities go up, they're getting commissioned in this quarter. We will see more of capacity working capital getting unlocked, and that would reduce the debt going forward. So from a ratio perspective, we are quite stable, and we would continue to focus on our ratios and maintain them to be at a healthy level.
Can we talk to us a little bit about your capacity expansion plans? Also, your progress towards achieving net zero, the challenges there.
So our capacity expansion plans are on track. In this quarter, we would be commissioning a 5 million ton facility at our South India works at Vijayanagar. And we are adding about 1.5 million tons commissioning in the East works. Now, we would be ending this year closer to 35 million ton plus as we finish this financial year. We would be doing some more debottlenecking, which would add another 1.5 million ton just at the end of this year going into the next year. So JSW Steel will enter the next financial year with a capacity of 37 million tons in India and 38.5 million tons worldwide. Our plans to take up the next capacity expansion in our West works has started. We would add about 5 million tons there. So we should be 42 to 43 million tons as we see in the FY27. In terms of the second question which you asked one was on capacity expansion. The second one, I'm just missing that one.
Well, I believe we're actually out of time, Jayant, so we'll have to leave it there. But thank you so much for joining us today. That is Jayant Acharya of JSW Steel. Bloomberg's Menika Doshi joining us well from Mumbai. Plenty more to come. This is Bloomberg. All right, let's take a quick look at how markets are tracking, particularly the so-called Trump trades. We're seeing a bit of fluctuation in this since President Biden decided he wouldn't be re-seeking the nomination. Got the US 10-year there, 423.69, slightly weaker dollar. That's it from Bloomberg Markets Asia. Horizons, Middle East and Africa next.